Hi, this is PR Sundar. Welcome to Mission Options Series 2. In the last episode, we have seen long call, and today we are going to talk about long put. Long put means what? You buy a put option. When you buy a put option, when you expect the prices to go down and you want to benefit out of that, so you will buy a put option. Say for example, Nifty is trading around 22,200, and for one or the other reason you are very bearish, you are expecting market to crash. So you go and buy 22,000 put option, maybe trading around 40-50 rupees. If market goes down, you will benefit. On the other hand, if market shoots up, your loss is limited to the premium that you are paying. So this is called a long put. Long call means buying a call option. Long put means buying a put option. When you buy a call option, when you are expecting prices to shoot up. When you buy a put option, when you are expecting the market to fall drastically. Here I tell you, there was one guy, he was the guy who coined the name Black Swan event. So what he used to run a hedge fund, so he takes money from people and he will buy, put options far out of the money put option, maybe for $1. Okay, most of the time that $1 will go to zero. Assume that you are buying a put option for $1 every month it goes to zero, right? Assume that for 10 years this has happened. Okay, 10 years is this happening. 10 years into 12 months, 120 months, you still lose only $120. But at least once in 10 years, something like coronavirus, something like Lehman Brothers collapse, something happens that $1 may go to $300 or $400. So there are people who do buy put option or a long put option far out of the money, so expecting this kind of a black swan event, but most of the time they will lose, but one time they can make good money. So this is one type of people who do. But generally professional players, they usually buy put option either at the money or slightly out of the money or slightly in the money if they take a bearish view about the market. Now, some tips. Usually when people buy put option, number one, assume that in a particular day, market is falling and closing at the lowest point of the day. Then the probability of market falling more is very high on the next day morning. So just like I told you in the call option, the market closing at the highest point of the day, the people buy call option. Market close at the lowest point of the day, people buy a put option and they take a chance. So technically, if the highest closing, always the probability of higher opening next day is very high. Lowest closing, the probability of market opening down the next day is very high. So this is what they call some technical parameters. This is one thing. Another thing, suppose companies declare results. You are expecting, a very bad result from a company, and the people usually buy the put option. So that, if the results are very bad, if the market crashes, and then you can get good profit. Say for example, in the month of January, HDFC Bank came out with results, markets were not happy. I think the stock fell 4-5%. The people who bought the put option, so they doubled or tripled the money. So when you are bearish, you buy a put option. When you are bullish, you buy a call option. Buying a call option is called long call. Buying a put option is called long put. Okay, but at the same time you understand, later in the series, I will also be talking about the effect of time value, the effect of volatility value, India VIX, all that, how it will be playing in the option prices. So buying a call or buying a put, the risk is limited, but at the same time, the probability is against you. The time value is against you. The volatility value, sometimes it may be against you or it may be in favor of you. So those details we will see later. So right now we keep things very simple. So buying a put option is called long put. So when you buy a put option, you buy a put option when you are expecting the market to go down or a particular stock to go down. And or if a stock coming out with results, if you are expecting bad results, market likely to fall, all those kind of things. Although I say so simply, practically it's not going to be very, very easy. And usually, who are the people who buy the put option? Let me give you one example. Suppose that I have a portfolio. Let us say I have a portfolio of Infosys. Okay, I think Infosys lot size is 400. Okay, assume that I have a 400 shares of Infosys. And tomorrow there is a meeting in Infosys. The results may come very bad. Okay, so I'm worried that my stock price may go down, or I'm expecting something, so something very bad. Let us say one of the promoters or one of the CEO is hospitalized. If something happens to him, then the probability of that stock may crash. So what I will do, either I can sell the shares, but the thing is, if nothing happens, a stock can go up also. So I don't want to miss the opportunity of making money. So in that case, what I can do, I can still hold the shares. I can just go and buy one put option. So that if tomorrow market shoots up, nothing to worry, just whatever money we spent for buying a put option, that's gone wasted. Okay, now we are safe. But in case some event happens, the market crashes, there may be loss in my portfolio, but which will be compensated by the profit in the put option. So usually, this is example I have given, but don't expect any promoter to be hospitalized. Okay, I wish all of them a very healthy life. Something like a Brexit happened in Britain, or a parliament election. If suppose 2024 parliament election, okay, assume that no party is getting majority, hung parliament, then market will crash. But in case if one party comes to power, then the market can shoot up. So both the possibilities are there. Market can shoot up, market can crash. But if you sell the shares, that's it. If the market shoots up, you lose the opportunity. So what the people do, they hold the shares, they don't sell the shares, but they just go and buy one put option for protection. So that's like, buying an insurance. So put option is being bought by the people for the purpose of insurance also, for the purpose of taking a directional bet. People are bearish, they can buy put option also. Now, I'm going to give a specific example for long put. Long put means buying a put option. When you think that the markets will go down, you can buy a put option. And look here, Nifty is trading around 22,358. And if I strongly believe that by the end of this month, market will go, Nifty will go below 22,000, I can go and buy a 22,000 put option. But that is trading around 136 rupees. Your payoff chart will look like this. Because you feel that market will go down, you are buying a put option. So if market goes higher, you will lose. The loss is equal to the premium paid. Whatever the premium you paid, the entire money will be the loss. But in case market falls, you will have an unlimited profit. Remember, you are thinking that market will go below 22,000. Sometimes market may go below 22,000, but still you may not make profit. Going below 22,000 is not enough. You paid about 136 rupees premium from your pocket. That will not come back to you. So the market should fall below 22,000 plus another 136. So that means what? 21,864. So market should fall below that. So that's what here it is showing that. Okay, break even. So as long as market is falling below 21,863, you will be making the profit. Anything beyond that, you will lose the money. So I hope this is very clear to you. So last video I talk about long call. So this video I talk about long put. So wait for the next video. Until then, enjoy your time. Thank you for watching.